If these businesses are now looking ahead to 2026 and saying, actually, we need a better way to achieve supply chain resilience, maybe if you do want better supply chain resilience, yeah, you're going to pay a bit more, but that's what you want.
If you say step one is, we know that the freight rate itself is marginal compared to the cost of not getting that container rolled. The next step is then, and then the third question is,
Welcome to The Freight Debate, the ultimate destination for supply chain professionals, logistics leaders, and anyone who's ever wondered what really keeps the world moving. As usual, on The Freight Debate, your hosts are myself, Phil Hennessy, and joined by Zanetta Senior Shipping Analyst Emily Stausbøll, who is braving a bit of a cold. Thank you, Emily, for still joining, even though you're a bit under the weather.
That's life.
It is.
Looking forward to this, wouldn't want to miss it.
It's the commitment to the freight debate and not wanting to let down our loyal listeners and viewers. But we have got a lot to cover, so let's hope your voice holds out. So it's been another interesting week again, hasn't it? Is it 2 weeks since the last freight debate? And we've got plenty to cover, haven't we? We've got Red Sea. More kind of developments or not developments, as we'll find out in the Red Sea. And we're going to touch on carriers' Q3 financials as well, and what that may mean looking ahead to 2026. So as I say, plenty for us to get our teeth into as usual. I don't even think we're going to sound the tariff klaxon this week, are we, Emily, for the first time in a while?
Well, you've just said it. So other than that, we can ban it as a word for the rest of the episode.
We're going to ban the word tariff. Okay, let's get going. Red Sea. We were in the news. Peter Sam was in the news, Bloomberg and such like last week, because there was reports. I think it was first broke in Associated Press that the Houthis had said they'd stopped attacking ships in Red Sea. But what's your thoughts? What's your kind of immediate thoughts on that, Emily, in terms of the situation and what the implications may be or not?
Well, it's obviously good news. The question may be to what extent, because we saw a similar message coming out at the start of this year when we had that first stage of the ceasefire, and kind of being put out that the attacks would stop as long as the ceasefire held. And I think that's a little bit the same situation we are in today. And that leads you then to question, okay, is this then something that we can count on in the longer term? Or is this something that lasts while the ceasefire holds? But the confidence in that is maybe less, and that's what's preventing carriers from... I think it's fair enough that carriers aren't saying, hey, look at this, let's go right back immediately. There's clearly some more longer term guarantees needed, both on this side, and that also then links back to that wider issue of conflict in Israel and Palestine. So it's a question of how much are you willing to put in, and I think the carriers are looking at this as good news, but they aren't making that decision to jump back in. They are waiting for some longer term assurances.
Yes, and without getting political about this, details are sketchy, aren't they? The article that started in the Associated Press was essentially a letter written by the Houthi militia. Now, as you say, it's positive news, isn't it? But carriers and shippers, but carriers, they're gonna need more assurance than that, aren't they? When it comes to risk assessment around their ships, their crew, and the cargo. It's not enough, is it?
Well, that it's both for carriers, but it also, very importantly in this discussion, is the insurance companies. What are they willing to insure you for? And that is also a major kind of, carriers will be wanting to see how that works before going back. We've seen it a little bit, and we've talked about it. CMA CGM kind of leading the way with some of their ships going through. Again, they have a slightly different risk profile, but even for them, they're looking at this very much on a case-by-case basis, and often with the support of the French Navy. So even for this carrier that's moved the furthest forward, it's still not a solution they've done as a whole, even just for one service. It is looking at this one on a case-by-case and seeing what they feel comfortable with and assessing the risk of each journey.
It's fair to say, isn't it, though, that in 2025 that transits, even though we had the kind of ceasefire, probably not the accurate word, a kind of ceasefire earlier in the year, we haven't really, other than kind of a few carriers testing the water and some carriers of lower risk, kind of smaller ships continuing to sail through, we haven't really seen.
Well, yeah, and that's important. We don't see it much on those top 10 carriers on the big international trades, but there are plenty of the smaller regional players who are continuing to sail through here, offering faster transit times and different connections. So, when we look at a map of kind of the global ships and we want to highlight kind of the impact the Red Sea has had, the first thing I go in and do is I say I'm looking only at ships above 8,000 TEU, because those are the ones where you see it most clearly. The smaller ship sizes operated by the smaller regional carriers are still sailing around the region. So it's important to make that distinction as well. But on those major long-haul trades, we're still seeing a lot of, the vast majority going around Africa instead.
Yeah, we're going to come on to the implications when there is a large-scale return of container ships to the Red Sea. But just before we do, there is an important point here around risk profiles that you've mentioned around CMA CGM and some of the regional carriers, that each carrier and insurance company is going to assess that carrier's risk, aren't they? Whether it's where their affiliations to certain regions or countries or political alliance, whatever it may be. I think what we need to be clear here is that we're banding all carriers together as one thing. All carriers, and it's not, is it? When there is a return to the Red Sea, it's not going to be all carriers at the same time. I wouldn't have thought. It's going to be different carriers, and once there's that kind of first few carriers that go back, and the pressure on the other carriers to follow suit is going to be huge, isn't it? Because there's the ones that start transiting Suez are going to be maybe at a competitive advantage at a time when they're fighting for volumes.
Yeah, unless you still have the very hesitant shippers who say, actually, I don't want to do this step now. For the moment, I know the longer transit times aren't great, but at the moment I've got that built into my inventory, I have that in my profile, I don't want to take this unnecessary risk. So it all depends, obviously, on the timeline, what else we can see kind of from that conflict and what happens there and how stable kind of the longer term looks.
Yeah, okay. So we've come to the conclusion, I think, very simply, that it's good news, is a positive kind of step, but unlikely to see an immediate large-scale return unless there are various other assurances that arrive. However,
and this is arguably a first step in that process. So of course it's a good step to take. It's just not quite enough.
Yeah, exactly. But in the freight debate, we're not adverse to hypothetical scenarios. So let's have a hypothetical scenario where there is a large-scale return to the Red Sea. Because I suppose I was going to say it's got to happen eventually. Maybe it doesn't. I don't know. But let's say there is a hypothetical return to the Red Sea. What would be the immediate kind of impact of that?
One of the biggest problems that's been mentioned really since we first started diverting is this question of ships suddenly arriving at the ports at the same time, and it's what we saw if you think back to sort of early 2024. We saw that increase in rates in January into mid-February on the major trades, and then it seemed to ease, and then we had a lot of congestion issues over the summer months, and that is kind of a risk because that is what happens when you kind of get those services adjusted and you're moving around the transshipment. So if you suddenly get a click and from this day to the next, everybody's going back through Suez and arrives quickly, you get a lot of these ships suddenly arriving at the ports at the same time. And that obviously puts a lot of pressure on the ports. Then in the slightly longer term, you have kind of these services being reset up. Maybe we'll see the shift back towards kind of the Eastern Mediterranean, which has seen some of its volumes cut out by ships choosing to stop off, for example, in Barcelona rather than sailing all the way into the Red Sea to kind of limit those extra transit time. So clearly that first kind of congestion in the ports, ships arriving at the same time, both in Europe, also in the Far East on the other side, and then over kind of a couple of months perhaps, that kind of return to what we would consider normal back in 2023 with the services set up as they were running back then.
The point that we talked about the requirements for a carrier to go back, because the absolute worst case scenario is not continuing as it is now, is it? The worst case scenario is not continuing to divert around Africa. The worst case scenario would be going back to the Red Sea and Suez Canal, and then in 2 months' time, when she'd gone through this pain of schedules and services realigning, is that there's another deterioration and attacks begin again. And then they have to go back around Africa. And as you say, the fallout from that in 2024 was enormous, wasn't it? The crisis escalated in December. And I think it was June, May, June, that we saw the real kind of peak in rates and congestion. So my point is, carriers aren't going to go back until they have assurances that it's a long-term solution rather than, something that could collapse again in a couple of months' time.
Maybe just to be 100% clear, we're talking worst case solution for shipping. These attacks, this whole conflict has far, far broader implications that are arguably far more important. But on the shipping front, the worst case scenario is you return, you have all this congestion, you start to ease that out, and then you have to flip-flop again. And that is the ports, the carriers and shippers who don't want that situation.
Okay, so that's the immediate implications of a large-scale return. So once we've gone through this kind of initial painful period where services are kind of rerouted through Suez and maybe there's a port congestion, once that eases, what would be the kind of medium to longer term implications of this return?
Right, I mean, here at Zanetta we spend a lot of time talking about rates, and that has to be the first thing that comes to mind. I think we've probably had this discussion previously that maybe at the end of 2024 we were looking at the situation in the Red Sea and saying as long as that happens, rates will remain above a certain level, carriers will remain profitable. And the reality is we're falling very close to that line now already, and that obviously only gets worse when you suddenly release all this extra capacity back onto the market. I think we put out a few weeks ago around 2 million TEU was our estimate on how much capacity is absorbed out of a fleet that's over 30 million. So it's a large share, and especially when carriers already now are dealing with that overcapacity. There will be a push for higher demolition, there will be a higher idle fleet, all those kind of things. But the idle fleet works in the short term. Demolition takes much longer to get through. We also have some of these charter contracts where carriers are having to sign up to longer and longer contracts because these ship owners, the non-operating ship owners, these vessel tonnage providers, they are looking for those longer term deals because they also see that the market will drop. And those contracts are there for maybe 6 to 12 months, and you can't just suddenly say, I don't want this anymore because we return to the Red Sea. So it takes longer for the fleet to adjust, especially when you think about how much overcapacity is out there. But that would clearly have downward pressure on rates even further than where we are today.
Yeah, and it was in the Zanetta 2026 Outlook that we published last month that there was the record order book, wasn't there? And admittedly, that's till 2030, I think it was. But there's the record order book, and most of that was from 2027 onwards. But even allowing for that, fleet growth was still looking like outstripping demand growth in 2026, wasn't it? So.
Yeah, and even if we had no demand growth next year, currently, if you compare to 2019, the fleet is up by more than 40% compared to the ground growth of 11. So we don't even need, it's going to get worse in 2026. Less worse in terms of how they grow apart from each other, but you cannot ignore this overcapacity, let alone then the further 10 million TEU that is currently in the order book.
Yeah. Okay, so we've just painted a pretty gloomy picture for carriers from a financial point of view, to be clear. As you say, we are talking about specifically container shipping, not the wider kind of political aspects of this whole situation. But from a purely container shipping point of view, yes, positive movements in terms of return to the Red Sea. But we just painted a really gloomy picture for carriers, haven't we? Looking forward to 2026, irrespective of whether there's a large scale return to the Red Sea. They're looking at a challenge in 2026. So if we're looking at downward pressure on rates, what are carriers going to do, Emily? What's their approach? What's their tactics for 2026? Because it almost feels like they're in a every option they have doesn't look particularly appealing, does it?
No, that's true, and I think we're getting more and more tender rates coming in, showing sort of very competitive rates coming in that clearly indicate that carriers are wanting the volumes ahead of kind of wanting higher rates. Of course, ideally they'd have both, but the reality that they're all looking to, even with these kind of more recent spot rate increases on the major trades, those long-term rates are coming in at very competitive levels. And I think, it's an interesting discussion because you mentioned the carriers' Q3 results, and I just want to focus on a second on Maersk and Hapag-Lloyd in particular, these two Gemini partners, who are kind of trying to move the industry forward. And talking now for the first time really publicly, I'm sure this is a discussion they've had privately a lot, about somehow charging a premium for high reliability. And we've had a lot of conversations. We've probably spent half this podcast talking about how shippers are moving on from rate being the only sort of consideration when they're tendering, that it's only about cost and everything else is relevant. And that's a trend we saw really in the many years leading up to the pandemic, where the only thing that was important about containerized shipping was getting the freight rate as low as possible, and the only way carriers could really make money was in cutting their costs. So basically in a case where you couldn't get more money for having high reliability or other kind of things that play in there. And that's what they're now coming back to and trying to charge. I think there's still a lot of skepticism in the market, but the reality is so far they've kind of lived up to that 90% promise on reliability. And if a shipper chooses actually, I
Not
believe
quite.
this is...
Well, just for kind of points of order, they were slightly below the 90%, were they? They didn't achieve it on all of the trades. There might be other carriers out there saying, no, they didn't. so I think they achieved... I think it's fair to say that they're way ahead of the competition, but didn't quite hit the 90%.
Right, thank you. I was going to say, what is the competition at? Because that is also, if everybody else was at 75, 80, it'd be a different story. But I think it's fair to say they're not. So the question then for them is obviously, can we charge more for that? And I think if you've been in the industry for the past 10, 15 years, you'd probably say no. But I think, at Zaletta, we cover ocean freight, but we also cover air freight. And I think that gives an interesting perspective, because probably the most common discussion I have with our airfreight analysts is what is happening with ocean schedule reliability. Because there's a very strong correlation between ocean schedule reliability and how much cargo shippers choose to move from ocean to air freight because they need it. Now, that's also higher transit times, but it has a lot to do with ocean reliability. So if you then suddenly have these two carriers saying, actually, I can promise you 90-ish%, and I've been able to prove that, and a shipper says, okay, I now believe in this, that has implications on inventory levels, it has implications on all sorts of stuff. And if you think that maybe in the past they would say, actually, we need to air freight it, you don't have to, if you compare that air freight rate for those container worth of good compared to paying maybe a couple of $100 premium, that's a pretty good deal to get a much higher reliability level. So I think in that perspective, it is something that can manage. The question is firstly, are we too soon? As you say, do we need another 6 months, year before shippers are saying, actually, not only am I paying for Gemini, I'm actually also cutting the other things associated with it. So I'm saving money because of their higher reliability. And then secondly, in this market, when volumes are so seemingly plentiful, and that's how carriers are approaching this tender season, will Maersk and Hapag-Lloyd have enough people queuing up for their service that they can then kind of pick and choose? Or are they still saying, we need everything we can get, and therefore we can't push the prices up? Maybe we could if the market was better from a carrier's perspective, but because of how poor the outlook is today, that might well be trickier in the tendering process. So I think it's probably something we'll see in the future if they can keep delivering, and perhaps just as importantly, they can keep outperforming other carriers by so much that it continues to be a discussion. But whether the market is a little bit too poor now, and whether it's a little bit too soon for shippers to be willing to pay that extra, well, we'll see. But I don't think we'll see that full effect this tender season.
Yeah, do you think? I mean, it all makes absolute sense, doesn't it? And it is almost a risk to the Gemini strategy that if a shipper knows that vessel is only going to be half full, then even if it's high reliability being on offer, they know they don't need to pay the premium because the carrier wants their volumes. So it is maybe a little bit premature. And also, do you think other carriers will be looking at this situation, won't they? And looking at Gemini reliability, does it almost reduce the incentive for those carriers to keep up or try and emulate the Gemini reliability hub and spoke kind of model? Because is the financial reward there for them to do it? Do you know, like we're questioning here, aren't we, whether there's the fact whether Gemini can actually use their reliability to make more money through higher rates. If they can't, and it is too premature, then you'll be another carrier thinking, well, I'm not going to put loads of investment into increasing reliability because I can't charge for it, So could we be looking at those carriers' reliability maybe not improving in 2026, do you think?
I think just because they can't charge for it now doesn't mean they can't in the future. And as we've seen with Gemini, this is a multi-year process. This is not that something that they dreamt up overnight and they clicked their fingers and they were ready to go. This takes years, and all the other carriers will be looking at this. Maybe they don't think it's with these hub and spoke model. Maybe they believe they can get there on direct. But if we're looking into a future where we have all these shippers talking about reliability, they're getting more and more incorporated into deals, and we think over the longer term that maybe this is enough to kind of get Gemini a premium on other shippers, then I think the other carriers will follow. Perhaps not to the same extent, but you can't just say it's not working for them this time. It doesn't work for anybody, because I think at the moment kind of the dynamics in the market are so poor that you'd have to have such a great idea and different service level. Everything would have to be, rocket fuel, and your transit times are also cut in half. Maybe then, but I think in today's market it's going to be a real struggle. But that definitely doesn't rule out that in the coming years it becomes feasible for them to achieve, and therefore other carriers will want to emulate.
Yeah, and one thing that maybe that comes to mind that does play into Gemini's favour is the turmoil of recent years. And your large shippers, and not even large shipper, any shipper, valuing supply chain resilience above maybe the cost, because they've seen in recent years that the cost to their business of supply chains falling down, and they're not being able to get goods on shelves, or not getting parts into factories or materials where they need to be, is huge. So if these businesses are now looking ahead to 2026 and saying, actually, we need a better way to achieve supply chain resilience, then actually the cost of ocean freight, albeit is significant and it's the focus of our conversation, but it is only one part of that supply chain, isn't it? With trucking and rail and warehousing and sourcing and, all that kind of stuff. So maybe Gemini can tap into that process that shippers are going through and say, if you do want better supply chain resilience and you are going through this transformation project for supply chain, maybe that's what they will tap into, isn't it? Where, you're going to pay a bit more, but that's what you want.
I think that's kind of, if you say step one is we know that the freight rate itself is marginal compared to the cost of not getting that container rolled. We've spent an awful lot of time talking about it. That's where indexing comes in and all the rest of it. But the cost of not getting your container moved is higher than an extra $3,000, even far more. The next step is then thinking, do I believe Gemini can deliver what they promise? And do I think I have enough data now to go with that and accept that actually I want to go with Gemini and I'm willing to pay more? And then the third question is, are there enough of those customers that Gemini can then charge a premium? And I think we've got step one, we've got that. You say, they're not quite there, but we have almost half a year of them, really outperforming the rest of the market. That then I think I know we have shippers who are willing to say, I'm not interested in the lowest possible freight rate, I need a good service. The last one then is how many people are they willing to, and do they need to pay extra to secure it? And that's where I'm getting a little bit more stuck at the moment.
Okay, so plenty of questions, but interesting times ahead for Gemini, but all alliances and carriers. We're going to round off this episode of the Freight Debate by quickly looking at carriers before Emily's completely gives up on us. So we're gonna get through as much as we can while you still can, Emily. Carrier Q3 results, because this sets the bit of a context, doesn't it, to the discussion that we've just had around the implications of falling rates in the Red Sea and looking ahead to 2026 and fighting for shipper volumes and such like. So where are we? What we hearing or what we reading from the reports from carriers for their financials?
Well, if we stick with Gemini for a second, what's interesting is both of them, if you take Q3, are seeing a much higher volume growth than the global average. So the two of them have been able to gain some market share. Now, that's come at a cost. If you look at Maersk's results, their average rate was down just over 30% compared to Q3 last year. So that's clearly a really big difference, and it's the lowest they've been at since Q4 2023, which was when they reported losses. So
yeah, I'm sure, Emily, as well, that their operating costs will be higher. What their actual operating costs will be much higher than Q3 last year as well. So that 30% drop in rates is actually kind of compounded by rising operational costs as well.
Yeah, absolutely. And Hapag Lloyd have been out quite clearly saying they're looking at cost cutting, which is something we were very used to hearing back before the pandemic, but we hadn't really heard we heard maybe for a quarter or two in 2023 and nothing since. So coming back to that again, of course they want to charge a premium, but they're also looking at their own costs. And I think, they're making more money than they did in Q2. But if you think about what happened, particularly for spot rates, and of course they have a different exposure to spot versus long-term rates. I think Maersk these days is about 50-50 in contracts under 3 months versus those over. But we had these spot rate increases over the summer, which will have benefited them. And if you think about what's happened since, end September, we basically had a month and a half of falling rates lower than they were. We've got some spot rate increases. But it's quite worrying for them that we're already seeing those big decreases in Q3, when the big drops are coming in Q4. And when we look at these tender rates, we're going to see much, much bigger drops when we get those long-term rates for January coming in. So it's a worrying picture for them that they've already been hurt so much in Q3 when we know what's happening now, and we have a relatively poor outlook for them in 2026.
Yeah, and shippers will be in no mood to go easy on the carriers in the tender negotiations, will they, after recent years? So it's going to be really difficult for them, isn't it? Not that, as I say, too many people will be shedding tears, because the past few years has been the complete opposite for carriers, hasn't it? And maybe this is, is this just the cyclical nature of container shipping? And on that point, we were saying the same thing, weren't we, back end of 2023? And then the Red Sea crisis escalated. So again,
which, hang on, if I remember, you've been at Xeneta now for 2 years. So you had about 2 months before we hit by Red Sea. So you don't really know what happens in container shipping when things are normal.
No, it's been absolutely crazy. And I joined October 1st, and Red Sea escalated kind of mid-December. But I remember distinctly that as I was kind of getting to know and get up to speed with the market and all of the dynamics at play, the first couple of months was exactly these type of conversations, which was the rates are falling, overcapacity, what are carriers going to do, and such like. And then wham, mid-December, the roller coaster started, and we're still going. Whether it's been it's been tariffs, we've had the port strikes, haven't we?
We were so close, Phil.
Oh no, the tariff collapse. We nearly made it to the end of the podcast without mentioning tariffs. So I you win the bet. But yeah. So basically, my entire time at Xeneta has been a roller coaster in terms of trying to keep up with the market, and the point being, if that trend continues, then we are in store for more ups and downs and twists and turns in 2026. Who would bet against it? They'd be foolish.
Not me. Yeah.
No, exactly. Right, Emily. To round off this episode of the Freight Debate, you've done some analysis, which I'll be honest, I find pretty difficult to get my head around. So let's do our best to educate our viewers and listeners to the Freight Debate, because it gives a bit of a window into the challenges facing carriers, and its Roundtrip earnings. Can you try and summarise? Maybe our listeners are far better at this than me, but
maybe they've had a few more years.
Let's give it our best shot.
So I think this question of round-trip earnings comes up as soon as we start talking about what rates are profitable and what rates are unprofitable for carriers, because the way this trade is set up, you will almost inevitably have more containers being moved on one way on the front haul than are going back on the back haul, and that means that you don't have those capacity issues, and carriers can only get much lower rates on the back hauls, except for some few examples. I think we saw briefly in 2020 that it was actually more expensive to ship from North Europe into the Far East and vice versa after Far Eastern manufacturing had collapsed. But generally speaking, and definitely what's the case today, that you need those front haul earnings to be high enough to cover the fact that the ship also needs to go back, and that at the moment you're getting very little help from backhaul rates. So if you think, the one example we come back to all the time is that North Europe to Far East rate. It's currently costing you just under $200 to move a container from A to B there. That's nothing, right? On the front haul, it's gone down the spot rates, but we're still at above $2,000. So you're losing that kind of back end of the earnings. It's about half what it was 2 years ago, the backhaul rates. Of course, $200 is not a lot, but if you think about it, it used to be maybe $600, maybe even $1,000. That suddenly brings your round trip earnings up. Whereas now there's even more pressure on the front haul to be able to make up for the total cost of the round trip. And if you just take on the transatlantic, what it is around about a 5-week round trip is netting carriers around $2,000 per box at the moment. That is really not a lot of money when you consider that's both sailing back and forth and having to cover those costs.
Yes, I mean, I do follow it now. Now you explain it extremely well. Thanks, Emily. And again, it points at an extremely gloomy picture for carriers, doesn't it? And again, to emphasize the point and the kind of the main topic of this episode of the Freight Debate, which started with the Red Sea situation. This is the status quo, isn't it? The challenges of round trip earnings is with the status quo as it is now. If we do see a large scale return to the Red Sea and a kind of flooding of that 2 million TEU of capacity into the market, then it's going to get even worse, isn't it?
Yeah, and this is what we're looking at here is on a per container basis. So then you have to take into account if we suddenly see volumes dropping, that they're actually making this lower earnings even less because they can't fill those ships up. And it all plays in. And I think the two big factors here are obviously backhaul rates have been very low and didn't see the pressure that they actually got during the pandemic. And then the second thing impacting on this is that many trades are getting even more imbalanced than they were before. So if you take, for example, Far East to US West Coast, we used to be about 3 loaded imports to the US for every 1 loaded export. That's got now a ratio of 4 to 1. Into Europe from the Far East, we used to be at just under half, so 1 loaded container going out for every 2 coming in. And now that's fallen to a third, so 3 to 1. On the transatlantic, it's a little bit more positive. It's still a 2 to 1 ratio, but you're getting lower rates for the backhaul, and even at those lower rates, you're securing fewer volumes, and that just makes it even worse for carriers. But it's definitely a concerning picture as they go in and look towards 2026 and try and figure out how they're going to make money. Now, of course, a return to the Red Sea suddenly reduces the round trip length and the cost of having the ship available. But it's still, even without that, it's still concerning reading for anyone invested in carrier profits in 2026 and even in Q4 this year.
Amazing. Thanks, Emily. And the analysis that Emily has just described, the round trip earnings, we do produce customer-only reports for Xeneta customers produced by Emily and our chief analyst Peter Sand, and that's one of the reports that she just produced. It is a phenomenal piece of work, actually. Well, I say it's phenomenal. Carriers might not feel it's phenomenal.
I'll stay silent.
Yeah, carriers may not feel it's phenomenal, but yeah, wonderful. Okay, Emily, on behalf of the Freight Debate listeners and viewers, thank you for soldiering on through this episode and getting to the end of it, because it's been great. Another really interesting discussion. I'm sure there'll be more twists and turns to the Red Sea, and we'll cover it in future episodes as well. But in summary, Red Sea, potential for massive ramifications, but maybe not yet. But in short, regardless, carriers are in for a bit of a stormy 2026.
Yeah, and behind the scenes, we're getting more and more of those 2026 rates coming in that are kind of showing to us more of how carriers also see it, because they're going to talk about one thing, but in the rates that they're offering is tells a different story. So that's also giving us a lot of more clues, because we can sit here and talk about 2026 and capacity management and what carriers are going to do, but we're getting more and more of those clues in those tender rates as they come in.
That sounds like a episode of the Freight Debate in itself, doesn't it?
There we go.
Sneak peek. Okay, wonderful. Emily, thank you very much. Go and get yourself some hot tea or hot lemon drink, and thank you very much. Thank you to everyone for listening and watching. We hope you enjoyed it as much as we did. If you did, please like and subscribe to the Freight Debate, and we'll see you on the next episode shortly. Thank you very much.